The JMF Advisors Show is a podcast for business owners, C-suite executives, and entrepreneurs who are looking to build, grow, or even exit a business.
We bring in some of our best financial advisors to interview experts on business best practices, hot topics, and sprinkle in some tax and accounting help.
If you're a business owner, startup founder, CFO, or just starting your side hustle, this podcast is for you. All right, welcome back to another edition of the JMF Advisors Show. Rachel, thanks for being in with me. You and I have done a couple together, so I appreciate it.
Good to be back.
So I'm Bobby Bragg with Jameson Money Farmer, and I'm here with Rachel Taylor, also JMF. We've talked about, so I counted before we came in. We've had 11 different people in studio, JMF people in studio for all of these things. So we try to bring in the experts in their areas to give commentary on those. It seems like in every one of those episodes we've asked, hey, if you got any questions, ideas, podcast show things that we would ask those in every one. Mm-hmm. So we've got a list now of some of these common questions that we get, and we've polled people inside our office.
Yeah.
So the way today is going to work, it's going to be different than the others. I'm just going to rapid fire questions, let you answer, and then we'll actually bring Lauren Roberts in as well. She has a handful that she can knock out too. But from a podcast perspective, we'll do all of them together, and then we're going to chop these up into individual questions and have them on our website for people to go back to for reference.
Sounds like a good plan.
All right. You want me to throw a question not on the script, or you want me to just stick to the script?
We can go however you want to go. I'll do my best.
All right. We'll stick with the script for now. How about that?
Sounds good.
All right. So we get this question a lot, especially this time of year. Explain what these tax organizers are that, generally speaking, we email, but we do mail some of them to clients every year. So what are they? Why are they useful?
The tax organizer is a packet of information that is designed to help you organize your tax documents. So appropriately named. It'll have questions in there about things that you may have done during the year. Did you get married? Did you have a child? Did you buy or sell a house? And it can get more complicated than that, but that's just the high level type of information we're looking for, to change banks, that kind of thing. But then following that will be pages that mimic the tax return. So a page is for wages, interest and dividends, and itemized deductions and that kind of thing. It'll show you what we had last year. So we had W-2s from these 2 places. We had 1099s from these 3 places. And that just shows you this is what we expect you to return back to us this year, simply based on last year. Because most people are creatures of habit, kind of have the same things from year to year. So we encourage people to use it, not necessarily as I need to write something on every page, but almost use it like a checklist. Okay, here are these W-2s. All right, I've kind of put them in my package, put them in my envelope to return to JMF, and then just keep going from there. Or I can say, man, I changed jobs. I'm going to scratch this one out. I'm going to write in the new one, just so it's obvious you're missing that W-2, but that's because I don't have it anymore.
Right.
So that's basically what they're designed to be used for. A lot of people don't use them. Maybe it's because it's too many pages. It's kind of overwhelming, and they just don't want to fool with it. So we have pivoted to, starting last year, where we give them to people who either we know use it, we mail it to them because we know they use it, we know they want it, or if people ask for it, we'll send it to them. We're going to follow that same pattern this year. It just cuts down on extra mail and that people don't need. But we also have an opportunity this year to more easily provide an electronic version of the organizer. So we're going to try doing that with some more people this year, just thinking maybe people would prefer that. They don't really want the paper, but maybe they wouldn't mind an electronic one where they can just do it all on screen, answer some questions, upload documents. So we do have that option this year. So if for some reason you don't get one, either by mail or by an email link, then you can reach out to your accountant and we'll get it to you.
Awesome. Great stuff.
Yeah.
You mentioned a lot of electronic things. So what are all of the ways that you can get information related to your return electronically from JMF?
And accounting is not that different from other industries. If you were to purchase an insurance policy or close a mortgage, chances are there's some electronic signing happening in there. So we like to do the same thing for our clients. We've got people that are out of town, traveling. They just don't have time to come to the office, but it's just way easier for everybody for us to deliver your tax return electronically and also collect your signature electronically. So that is going to be basically our default going forward. We're going to try to do everything we can electronically, which means if you're a taxpayer, you would receive an email with a link that would allow you to download your tax return, make your payments, set up estimates, sign your tax return, and then download a copy of that tax return, which we encourage everybody to do. Save it in the cloud, save it on your computer, wherever you typically save things, so that if you need to send it to the bank or somebody, your financial advisor, or somebody later, you'll have an easy access to that. So we hope that it works out really well for us, because we can get stuff to clients a lot faster. We can collect electronic signatures faster, but we hope it's better for our clients because it's faster for them too. A lot of them don't want paper anyway. They don't really want to keep paper records. So that's what we're hoping. And we're just, every year that seems to become more popular with people.
Yeah, great. Good answer there. So when, as a client, when should we plan to bring in, all of our tax information to our JMF CPA?
Well, I mentioned earlier that we are, as human beings, a lot of us are creatures of habit. So even if we have all of our documents in early February, we still might kind of hang around and not bring our stuff until March, just because maybe that's what we've always done. And we are encouraging everyone to try to be more proactive this year. So that includes us at JMF, that includes our clients, to just try to be more proactive, because like other industries, we are experiencing staff shortages. And so that means that tax season becomes more of a crunch, and we can't wait until a few weeks before the deadline to get all these documents in, because we just simply won't have the manpower to get everything done. So we need people to bring their stuff in earlier. A general good rule is 4 weeks before the deadline, or we will need to request an extension, just simply based on the time constraints it puts us under. So, and I have found that a lot of times people have their documents, they just, they may just not be bringing them in for one reason or another. So if you can't make it to the office, don't want to put your documents in the mail, we have a very secure way to email documents to us. And I think that will be a good option for people, because they could probably do that a little quicker. They can use that electronic organizer, or they can just email securely documents to us. So we're just asking people to just be a little bit more proactive this year. Get your stuff in a little earlier, unless, if you do indeed want to file on time, or you need an extension calculated, that kind of thing. So that's what we're shooting for.
Gotcha. Thank you. So what is a business expense?
That is a great question. So the law tells us that a business expense is defined as ordinary and necessary in order for it to be deductible, which ordinary and necessary is exactly what you would think it would be. But it also differs by business, because what might be ordinary and necessary to a retail store would not be ordinary and necessary to a manufacturing company. So it differs by business, but it needs to be something that makes sense for the business, needs a business purpose. That's a big one. A lot of clients and business taxpayers keep up with meals and entertainment. They might take their clients out, take their customers out. They might buy meals for their employees, their staff. And the rule has changed on that. So if it's a regular restaurant meal, not food you buy at a grocery store or at the gas station or something, then those are not limited to 50% deductible as they were in the past. For 2021 and 2022, those types of meals are 100% deductible. So that has helped people. They don't have to necessarily keep up with what it was, because we know that's just 100% deductible if it's restaurant meals. There is no deduction for entertainment expenses. So that affects things like taking clients to a football game or a basketball game. If you buy food while you're there, you could deduct that. So it's important to get, if you get an invoice, to have it separated. This was the entertainment part, the tickets, the box we were in, whatever. And this part was the food, the drink. That's helpful because it is deducted differently. There is no deduction for personal expenses paid through the business. So if you do make personal purchases through your business, those would just be considered non-deductible, a distribution, that kind of thing. A lot of people do purchase assets with a useful life of greater than a year. So maybe a vehicle or a piece of equipment or something along those lines. Those can be deductible in the year it's purchased through 100% depreciation, through 100% bonus depreciation, 100% 179 expense. But those have their own limitations. The 100% bonus depreciation will be phasing out after 2022, go down to 80%. It's not going away. It's going to have a gradual step down. 179 expense, which is 100%, will still be in effect, but it also has its limitations. You can't use it if you're taxable. If you have a tax loss, if your taxable income is less than zero, there are certain thresholds there's a max that you can take. So it's just got some more limitations. If you don't qualify for bonus depreciation or 179, most people are pretty familiar with depreciating an asset over a certain number of years. It's longer years for a building compared to a computer, which wouldn't last that long. So that's a big one. So it's important to keep up with those assets. And then several years ago now, I guess, we got these new repair regulations, which allows us to deduct, even if it is a new computer, if it's less than $2,500, we can expense it under those regulations.
Right.
So it's different from the 100% bonus. So there's a lot of different things. So it's important to keep those good records of what you bought, when you bought it, how much you paid for it.
Got it. Great. So how long should I keep my tax returns and all the backup information and whatnot?
The general rule is 7 years. We tell people to keep their documents for 7 years, their tax returns, their documents that go along with their tax returns, W-2s, 1099s. The IRS statute of limitation is 3 years, which means once you file a tax return, they would have 3 years to question you about it, to open it back up. Once the 3 years has passed, generally they can't go back. There are specific rules for substantially understating your income. They can go back farther, but the general rule is 3 years. There are different rules. If you're a business and maybe you have personnel records, you've got different types of things. There are different guidelines that maybe aren't tax related. They're maybe governed by some other entity. So if you have questions about specific types of documents outside of tax returns, you can visit our website, jmf.com. We do have a brochure on retention policies if you're curious about specific types of documents.
Awesome. Thank you. So when do I need to file a gift tax return?
Yes, I get this question a lot because people, maybe at the end of the year, they want to give some money to their children. They're helping a child buy a house, want to help them with a down payment. So they want to know, do I need to file a gift tax return? And if not, or if I don't want to, if I want to try to avoid that, how much can I give someone without having to file one? So that number has changed, the dollar amount. For 2022, it's $16,000, which means I could give however many people I want $16,000 each. So if I'm married, then my spouse and I could each give a person $16,000. So if we had one child, we could combine to give that child $32,000. It's going up to $17,000 in 2023, but the rule would still apply. So the dollar amount's just higher. So that's the general dollar figure that people a lot of times look for if they're trying to pass along some income, some wealth, maybe to their descendants or to just whoever, or if they just have an opportunity they need to help somebody out financially, then that's the amount. And that's just a way to avoid having to file a gift tax return at all. There are ways to give people money or property or something, filing a gift tax return, but not having to pay gift tax by using your lifetime exemption. So, but the general question I get mainly is about those just smaller gifts that are considered gift tax.
Awesome. That's great stuff. I appreciate you sharing those answers to these frequently asked questions or common questions that we get as tax preparers and financial advisors. So I appreciate it. And I'm going to, if you don't mind, we'll bring in Lauren in a couple minutes. All right.
Absolutely. Thank you.
Yeah, you bet. Thank you. All right. Well, welcome, Lauren Roberts. How are you?
I'm good. How are you, Bobby?
Great. We've both done a lot of podcasts.
Yes.
I don't know that we've done one together yet.
We have not.
All right. So looking forward to this.
Yes.
You know, I've kind of set it up with the prior questions. We've done about, I don't know, 6 or 7 questions so far. You're going to give us some of your answers to some of these common questions. So I appreciate you offering to do so. I can just get started.
Okay, shoot.
Why do I need to make estimated tax payments?
To avoid a penalty. It's a requirement. It's a low requirement. If you are expected to owe tax of $1,000 or more, not counting if you have withholding, you have a requirement to pay quarterly estimated tax payments. And if you don't, the IRS will penalize you for that.
Alrighty.
Yes, and usually we see this if you're self-employed, you don't have employer withholding taxes for you. If you're retired, so that's a change. If you're recently retired, you need to consider this. If you're not having withholding taking out of your Social Security income or your retirement income, which you can set up withholding for that, you need to make quarterly estimated tax payments.
Got it.
And those are due April 15th. June 15th, September 15th, and January 15th. So you kind of take what you expect to owe. They expect you to pay 90% of your current year tax or 100% of your prior year tax, because sometimes you don't know what your current year will be, whichever is smaller. And they want you to divide that up in, to 4 payments.
Got it.
It's the easiest thing to do.
I got you. So what's an RMD and why is it important?
The required minimum distribution is important because there's a requirement once you reach now the age of 72. Now, if you were 70 and a half before January 1st, 2020, that requirement started for you at 70 and a half. But after that date, the required age is 72, the year you turn those ages. You need to do a required minimum distribution because you also get penalized. And now this is a big penalty. It's 50%. That's 50. So if you don't make it, you have a large penalty for doing that, and it's a calculation. It's just based on your life expectancy calculation, and so often your who holds your retirement plan, or we might calculate it to let you know how much you need to do.
Excellent. So related to RMDs, there's something called a QCD. What is a QCD and why is it?
Yes. A QCD is a qualified charitable distribution. You need to be 70 and a half to make it. You can only make it if you have a traditional IRA account. So it has to be a direct transfer from your retirement account to a qualified charity. And now that's a 501c3. You can't do a private foundation. You can't do GoFundMe because hot tip, GoFundMe is not a qualified charitable organization. That's usually like a gift you're giving to like an individual in need or something like that. So you can't take that as a charitable distribution. So you just tell your retirement advisor that you want to distribute these monies directly to whatever organization you choose that's a qualified charity, and you can do it. And what happens is this escapes taxation. So you don't get to deduct it as a charitable contribution, but you also don't have to pick it up in income. And that's very helpful because a lot of people now with the standard deduction, we heard Rachel say earlier, I think 90% of people take the standard deduction, which is around, $12,500 for single and about $25,000 for married filing joint. And now that's not exact. It gets adjusted for inflation every year. So a lot of people now don't get to itemize deduction and benefit from their charitable contributions. So this way they can reduce their income when they can't take itemized deductions.
Excellent. Great explanation there. Why do you suggest setting up an account with the IRS?
Mainly right now is to make payments. The IRS has a backlog, and they're supposed to follow the postmark rule. So if you send an estimated tax payment, an extension payment, or an amount due on your tax return by the due date, as long as you get that in the mail by the postmark date, they're supposed to record it that date. As long as the postmark date, is either the tax deadline or before. Now, if it's postmarked after, they record it the date they receive. But we have had huge issues that the IRS is not recording payments on the postmark date. And so they're assessing late payment penalties, which is not good for us. And so now when you call, you would have to have, proof like tracking or something for these payments. And often we don't have that information. So now it's best to make all your payments online, and you have documentation when it was made and it was timely made. And that's important to do. And it's so easy to do to set up these accounts online. So now with the IRS issues and the backlog and processing mail, and they're not even following the postmark rule for us, it's definitely you want to make all the payments you can online.
And that online payment, they'll allow you to do a credit card or a ACH transfer, or how do they work that?
Yes, usually they prefer it from your bank account, but there are ways you can pay with a credit card, but they're going to charge you a credit card fee. And another thing is to keep in mind, if you have to transfer monies to make that payment, make sure before you submit it that money is there, because they do have a dishonor payment penalty, which is kind of like bouncing a check, but it's a lot more than like whatever that $35 fee is. I think it's 3% or something like that. So you want to make sure the money is there before you transfer it. Now, often we do have good luck if it's a significant amount and we want to ask to be abated, we could get a first-time penalty abatement. But you want to also make sure the funds are there before you submit that payment.
Gotcha. I guess in a similar vein, there's a Alabama MAT account.
Right. Well, I'll go back a little bit. For the IRS, you can go to irs.gov and you can set up an ID.me account. You just need your driver's license and a selfie, and it's easy to set up the account. And through that account, you can not only make payments, but you can access transcripts and that sort of thing, which are often an important tool that helps us. And we can get those, but we have to have a power of attorney on file. So also similarly, Alabama has the My Alabama Taxes webpage, and it's myalabamataxes.alabama.gov. And you just go to set up an account. Now for that, you do need a recently filed tax return, because you'll need your Alabama AGI, which is your adjusted gross income that you filed within the last 2 years, to set that account up. And there you can also make payments and, look at your account and that sort of thing. And when you make payments directly, you can see it's applied to your account, and there's a record of it if you have to pull it, if there's ever an issue and that sort of thing.
Got it. Can you explain the current set of education tax credits and opportunities, things like the 529 plans, prepaid tuitions, etc.?
Yes, I'm not sure about prepaid tuition, but there is 529 plan. There's the college counts, and each state has their own plan or something. They have more than just one plan, but Alabama has the college counts, and that's Alabama's 529 plan. And you can put money in. There's also on your Alabama tax return, you can take a credit for what you pay, so you can reduce your income by $5,000 if you're single, or $10,000 for joint. Reduce your income and take a credit for if you put that amount in. And now anybody can do it, like a grandparent. Whoever gives the money gets the deduction on the Alabama return.
Got it. Well, that's all the questions I have for you, Lauren.
Okay, great. Thank you.
Appreciate you sharing all that knowledge with us, and appreciate you being here. I'm glad it was finally you and I talking. And
Yes.
thanks everyone for listening in on our common questions. Hopefully these were helpful for you. We get them enough that we feel like a lot of folks will find this useful. So Thanks for being here. All right. Now, I appreciate everybody for listening to the JMF Advisor Show, and we'll talk to you soon. Thank you.
Thanks, Bobby.
If you would like us to help your business or would like to suggest additional podcast topics, simply send an email to info@jmf.com.
And don't forget to subscribe to our podcast on YouTube and your favorite audio podcast apps.